The world does not collapse with a single headline. It fractures quietly, through numbers that drift, spreads that widen, and confidence that erodes before it is named. In recent years, interest rates climbed at a pace unseen in decades, currencies swung with unusual violence, and liquidity once abundant became selective. Credit default swaps whispered before they screamed. Real estate prices stalled, then slipped, even as official data struggled to explain why. In this tension, Americans sensed change long before economists agreed on definitions. Grocery bills rose faster than wages. Mortgage rates doubled, freezing decisions that once felt routine. Retirement accounts moved sideways, then down, while policy statements promised resilience. This film begins at that uneasy moment when the global system appears intact, yet fragile beneath the surface. History suggests that crises rarely announce themselves as crises. They arrive as adjustments, justified as temporary, framed as manageable. But when multiple shocks converge, tightening financial conditions, volatile exchange rates, and slowing trade, the consequences no longer remain distant. They begin to seep into daily life, reshaping expectations, behavior, and trust. This is not a story of panic. It is a story of transition unfolding in real time. The early signs of crisis are often dismissed as noise. Markets fluctuate, cycles turn, and volatility is framed as healthy correction. Yet beneath that language, warning lights began to blink. Yield curves flattened, then inverted, signaling stress in future expectations. The dollar strengthened sharply, pressuring emerging markets and tightening global financial conditions. Capital flowed back toward perceived safety, draining liquidity from weaker systems. Housing affordability in the United States deteriorated as interest rates surged, even while supply remained constrained. Corporate refinancing costs rose, exposing balance sheets built for an era of cheap money. Abroad currencies slid, reserves thinned, and sovereign risk premiums climbed. None of these indicators alone confirmed a crisis. Together they formed a pattern. Americans felt it indirectly at first, through layoffs framed as restructuring, shrinking credit limits, and rising insurance premiums. The economy was still growing, officials said. Employment numbers remained strong, headlines reassured, but the mechanisms that absorb shock were losing elasticity. When liquidity tightens, stress does not break evenly, it concentrates. The system had begun to reveal where it was most fragile, even if few were ready to say so. Economic shocks do not move in straight lines. They travel through channels built over decades. Interest rate transmission, currency pegs, leverage, and expectations. When central banks raise rates to fight inflation, borrowing costs rise first at the margins, then everywhere. Adjustable rate debt resets. Dollar-denominated liabilities become heavier for foreign borrowers as exchange rates shift. Banks respond by tightening standards, not because they choose to, but because capital becomes scarce. Liquidity, once continuous, turns episodic. In this environment, small disruptions cascade. A missed rollover becomes a solvency question. A currency defense drains reserves faster than planned. Credit default swap spreads widen, raising funding costs further, validating fear itself. This feedback loop is the engine of crisis. It is not driven by a single failure, but by synchronization when households, firms, and governments all attempt to reduce risk at the same time. Spending slows, investment pauses, and trade contracts. The shock gains momentum precisely because rational actors behave defensively. What appears irrational in aggregate is logical in isolation. Understanding this mechanism is essential, because it explains why global stress, once initiated, rarely remains contained. Global history offers a map of how these mechanisms play out. In 1997, the Asian financial crisis began with currency pegs under pressure and ended with IMF intervention, austerity, and lost decades of growth. Thailand, Indonesia, and South Korea faced collapsing exchange rates as dollar liabilities overwhelmed domestic systems. Years later, Argentina repeated the pattern. Fixed currency promises, rising debt, evaporating reserves, and sudden default. Greece exposed another variant. where sovereign risk within a shared currency union translated into soaring bond yields, bank fragility, and social strain. Turkey demonstrated how inflation, political pressure on monetary policy, and external debt can combine to destabilize an economy even without formal default. Venezuela revealed the extreme where currency collapse and monetary expansion destroyed purchasing power entirely. These cases differ in politics and scale, but they share a common structure. External shocks meet internal rigidity. Liquidity vanishes just when it is needed most. The lesson is not that crises are identical, but that they rhyme, and those rhymes echo far beyond national borders, shaping how Americans experience global instability at home. For the United States, global crises rarely arrive as sudden collapse. They manifest as pressure. A stronger dollar makes imports cheaper but exports less competitive. Multinational earnings weaken when foreign revenues are translated back home. Financial markets absorb stress from abroad through bond yields, equity valuations, and credit spreads. When foreign systems strain, U.S. banks reassess exposure, pulling back lending even domestically. Housing markets respond not to headlines, but to rates. As mortgage costs rise, transactions slow, prices soften, and construction employment follows. Inflation complicates the picture. Supply disruptions and currency shifts push prices higher, while tightening policy restrains demand. For households, the contradiction is confusing. Costs rise, yet opportunities narrow. For small businesses, access to credit becomes uneven, favoring scale over resilience. The American economy remains large and diverse, but it is not insulated. It is a hub. Shocks that pass through it leave residues: lower growth, altered risk tolerance, and a reordering of who absorbs loss. This is how distant crises become domestic experience. Policy responses attempt to slow this transmission, but they carry trade-offs that shape outcomes unevenly. The Federal Reserve faces a dual mandate under global pressure: contain inflation while preserving financial stability. Rate hikes cool demand, yet they also reprice every asset dependent on leverage. Balance sheets adjust faster than incomes. Fiscal policy steps in selectively through subsidies, infrastructure spending, or targeted relief, buffering some sectors while leaving others exposed. Meanwhile, global coordination weakens as nations prioritize domestic stability. Swap lines restore dollar liquidity abroad, but only to chosen partners. Regulatory backstops prevent panic, but they do not restore confidence. Markets listen closely to tone as much as action. A single word shift can move yields, currencies, and equities within minutes. For ordinary Americans, these responses feel abstract, yet their effects are tangible. Credit cards reset higher. Savings earn more, but debt costs escalate faster. The safety net holds, but it stretches. Policy can delay crisis, redirect it, or soften its edge. It cannot erase the underlying adjustment already underway. As institutions recalibrate, individuals are forced into adaptation. Economic stress narrows choices long before it eliminates them. Households postpone large purchases, extend the life of vehicles, and reassess housing plans shaped in a lower-rate world. Adjustable mortgages, student loans, and revolving credit become sources of quiet anxiety. Savings behavior shifts from growth to preservation. Risk tolerance declines, not out of fear, but calculation. For workers, mobility slows. Job changes that once promised higher pay now carry uncertainty, as firms delay expansion and protect cash flow. Gig work rises, not as opportunity, but as supplement. Retirement timelines blur as market volatility challenges long-held assumptions. These decisions are rarely dramatic, yet they compound across millions of lives. The crisis, in this sense, is not an event but a pattern of restraint. Understanding this dynamic offers practical insight. Resilience is built less on prediction than flexibility. Those who adjust expectations early absorb shock with less damage. Those who wait for clarity often find it arrives too late. Financial markets translate these individual adjustments back into systemic signals. Lower consumption reduces corporate revenue forecasts. Slower hiring tempers wage growth, easing inflation but weakening demand. Equity markets reprice future earnings downward. while bond markets debate how long restrictive policy can last. Credit spreads remain elevated, reflecting uncertainty rather than panic. Liquidity exists, but it is cautious, favoring high-quality borrowers and short durations. In real estate, commercial properties feel stress first as refinancing collides with higher rates and lower valuations. Regional banks, concentrated in local lending, face scrutiny as deposit behavior shifts toward yield. None of this implies imminent collapse. It implies the economy is recalculating the cost of capital after a long distortion. For viewers, the insight is critical. Volatility does not mean disorder, it means transition. Systems adapt by redistributing risk often away from institutions and toward individuals. Recognizing where risk migrates into household balance sheets, job security, and long-term planning allows for informed decisions rather than reactive ones. International comparisons sharpen that perspective. In countries where institutions reacted slowly, adjustment turned into rupture. Argentina's repeated cycles show how delayed fiscal discipline and currency controls convert market pressure into social shock. Greece illustrates how external constraints can force rapid austerity, compressing incomes and reshaping political trust. Turkey's experience demonstrates the cost of resisting monetary tightening amid inflation, where credibility erodes and exchange rates absorb the strain. Venezuela stands as a warning of extremes, where monetary expansion severed the link between work and purchasing power. The United States differs in scale, credibility, and reserve currency status, but difference is not immunity. These cases reveal what happens when policy choices lag reality. They also highlight the advantage of transparency and adaptability. Americans benefit from institutions that adjust before panic, yet the burden of adjustment still reaches households. The lesson is comparative, not alarmist. Outcomes depend less on avoiding pressure than on responding to it early, consistently, and credibly. Credibility becomes the central currency in this phase of adjustment. Markets test it relentlessly. When guidance shifts too often, uncertainty hardens into caution. When projections miss repeatedly, trust erodes even if intentions remain sound. In the United States, credibility is supported by institutional depth, legal frameworks, and data transparency, yet it is also challenged by polarization and short-term political incentives. Debt levels remain high, making interest costs more visible in federal budgets. As yields rise, fiscal space narrows, limiting future responses. Abroad, investors watch these dynamics closely, recalibrating exposure not only to US assets, but to the dollar itself. Small changes in perception move large volumes of capital. For Americans, this manifests indirectly: volatility in retirement accounts, shifting mortgage expectations, and uncertainty around taxes and public spending. The insight here is subtle but practical. Stability is not the absence of change. It is the ability to manage change without losing confidence. Once confidence breaks, repair becomes far more costly than prevention. As confidence is tested, strategy replaces optimism. Individuals and institutions alike focus on survivability rather than expansion. Companies extend maturities, reduce leverage, and prioritize cash flow over growth narratives. Households seek predictability, favoring fixed-rate obligations and emergency reserves. Skills development takes precedence over speculative opportunity, as labor markets reward adaptability. These behaviors mirror what occurred in previous global shocks, from the post-IMF adjustments in Asia to the slow recovery after Europe's debt crisis. The pattern is consistent. Resilience is cumulative. Small, disciplined choices compound over time. The crisis, then, becomes a filter. Excess is stripped away, assumptions are challenged, and incentives realigned. For Americans, the actionable insight is clear. Preparation does not require forecasting collapse. It requires acknowledging uncertainty as a permanent condition. Those who build buffers, financial, professional, psychological, navigate volatility with agency rather than fear. This is how systemic stress becomes personal strategy. In the final frame, the camera returns to ordinary moments shaped by invisible forces. A family recalculates a budget as interest charges rise quietly month by month. A small business delays expansion, waiting for credit terms that feel stable again. A young worker weighs opportunity against security, sensing that the assumptions of the previous decade no longer apply. These choices, repeated across millions of lives, define the real outcome of global crisis. The world may feel unstable, but it is not directionless. Adjustment is underway, uneven and imperfect, yet deliberate. The United States changes not through collapse, but through accumulation of caution, adaptation, and revised expectations. The global system continues to turn, more constrained, more selective. In this environment, the lasting lesson is not fear, but awareness. Economic shocks will return in different forms. What endures is the capacity to recognize them early, respond realistically, and adapt without surrendering trust. That is how uncertainty reshapes a society.